That was the smart portfolio of Kartika Capital. Manish Sonthalia joins us now. Manish, if I have to put out a link or a graphic which says Manish Sonthalia smart portfolio, what should I write in that graphic? What do you think that graphic should contain? Which are your key stocks where you have a large exposure and stocks where you've reduced exposure? So why don't you walk us through that?
No, so we have really not made any changes, in the mid cap portfolio that we have, the multi cap portfolio. The same set of stocks do continue. So in some of the new AIFs that we have bought, we have been playing these four themes that we've been talking about for some time. And I think we have loaded up on consumption names like staples, etc. The shift from unorganized to organized. The private sector banks would be beneficiaries, and the doubling of farm income, going forward. So these would be some of the names that we would have in the portfolio.
Manish, now last time when I spoke to you was in and around the selling in the market, and your view was that forget about large cap and this entire investment belief, which is that mid caps are overpriced and large caps are underpriced. You were of the view that mid-cap stocks after the fall in the month of March and April, they were also looking attractive. So are you hunting in the mid-cap space?
Oh yes, there has been some recovery in the mid-cap names after the 20 to 50% carnage that we saw in the correction in the market, which took the market down from 11,200 to 9,900 odd levels. So from that point of view, some of the names were available at very bargain values, and we have just added on to them these names. There have been some new names that have come through in the portfolios, but the only disappointment so far is that the earnings season that has been playing out currently, it is the large caps which are actually delivering better on numbers than the mid caps. Mid caps have seen pressure on margins, even though top line growth is not that disappointing. So from that point of view, maybe the bullishness in the mid cap space will have to wait for some more time to have a runaway. And there's nothing very compelling at the current valuations in the mid cap space, so to speak.
Manish, the niggling factor is back to haunt us all. That's crude, already back above that $76 per barrel mark. Do you think this is going to be a niggling worry and a big impactor? You're already seeing it take a hit on the currency. We're already at Feb 2017 lows. And this is now bound to trickle down to various sectors, not just crude sensitives, but the RMC costs for a lot of these companies would also spike up.
Yeah, you are right. I mean, we are importing inflation. So even though, crude prices in any way are going up due to global factors, but at the same time, our own CAD, the current account deficit, standing at 2%, roughly 2% last year, and this year, there runs a risk that we'll be hitting somewhere close to 2.5 to 2.6%. If that happens, obviously, there's going to be pressure on margins, because I don't think the demand environment is that strong. Even though, extrapolating things from the GST numbers, 1 lakh crores collections per month, I mean, these are, some silver linings on the corporate India front. So it's going to be a challenging and a volatile, quarter going ahead, because crude above 75 does create problem for India. And we just hope that it doesn't cross beyond 80, because the current account deficit, etc., problems and weakening of the rupee will be there on the table. I mean, and there is no denying the fact, and that will bring pressure on margins even further going forward.
If my understanding is right, as a house, Motilal Oswal Asset Management was bullish on oil marketing companies. HPCL was one of the big positions. I'm not so sure whether you in your PMS scheme had it or not, but the AMC disclosures do indicate that you had a large exposure to HPCL and HPCL at least. So are you still optimistic on OMCs, or given the circumstances, it does not make sense to buy OMCs?
No, so we had a very high allocation in our PMS in HPCL. We had close to 14 to 15%. But I did take money off the table in HPCL. The large allocation of 14 to 15% got cut down to 5%, because obviously reasons were that we were looking at everything played out to perfection, and leverage in fact was going to increase given the mega capex on that company. And refining being a cyclical, we were not so gung-ho on the growth coming from the refining segment. Obviously, marketing margins was continuing to play out as expected given the deregulated environment. Now, all of that, was okay, but now, even the oil marketing companies are not taking regular price increases commensurate to the increase in crude oil prices. Obviously, the key question that comes before us is whether deregulation is on the table or off the table, because, in all circumstances, they were supposed to follow regular, marking up or marking down the prices based on crude oil prices. Having said that, I think a 4 to 5% allocation on HPCL does warrant attention, given the fact that the business model is good and valuations have even more become very reasonable. I think at less than 10p, and dividend payout, etc., would definitely not be equal to what it was last year. It is going to be lower given the capex, etc. But I think there is hardcore value on the table in oil marketing companies. That is not to say that the prices are going to move up starting tomorrow, but there's very little risk in the oil marketing companies at these prices. At least this is what I believe. But yes, it doesn't warrant a 15% or a 10% allocation, but a 4 to 5% allocation would be good, I would think.
Manish, would that be the strategy for aviation as well? Because ATF prices are likely to spiral up, and that's going to take a hit on the profitability and margins that these companies would be making, especially because pricing power doesn't seem to be with them. So while crude prices are moving up, ticket prices are as is. Or do you think it's about time that aviation would take that call and you would see a spike up in the passenger fares too, and then maybe these stocks could be a relook?
So aviation stocks is in for tough times. There's no doubt about it. In a benign crude oil environment, if there's no pricing power, given the commentary that has come out of the market leader, what is going to happen when crude oil prices go up? And the bunching up of capacities that is coming through, in the short term is somewhat creating a glut, because airline seats are a perishable commodity, and you got to fill up those seats before the flight takes off. And that means that the near term bunching of capacities, whether in metros or non metros, if that has to happen, there is going to be pressure on pricing. That is no doubt. And obviously RASK minus CASK, RASK minus CASK, is definitely going to be under pressure. And if the market leader is feeling the heat, the others of course will have very tough times. So it's a sector which is definitely out of favor in a rising crude oil environment.
Where are you picking your spots right now? I mean, private banks, I'm sure, would be the core position, but there's a limit to which you can buy or add to private banks. So if you've sold HPCL from 14% and bought it down to 5%, where have you allocated that 10% additional capital?
Yeah, so we bought into a federal bank, because we thought that there was value given the risk reward scenario seems favorable. We bought into agrochemical companies like Bayer Crop Sciences. We bought into Godrej Industries, given the sum of the parts value does seem to be much more than what the underlying see-through prices are. And we bought into one more name which I forget, but these were largely into the consumption names, and this is where we actually allocated. Sorry, the fourth name was Aegis Logistics. These were the four names where we allocated the allocations which we took off from both Bajaj Finance and HPCL, where we took allocation off and we allocated to these four new names.
What about the pure play up until now corporate banks and beleaguered ones at that, Manish? Both with Axis as well as ICICI Bank, you've actually seen that the numbers have been a little better than what the street was expecting. Do you think the worst is behind them? Is the pain now in the price? Because ICICI Bank just day before very categorically mentioned that they're more a retail focused bank now. They're cleaning up the corporate balance sheet. Or do you think the overhang of the current MD and CEO's tenure is going to remain on the stock price? price? Does it merit a relook now?
So I'm not so sure whether the entire NPA cycle has actually played out, because if you were on Kotak Mahindra Bank's conference call, um, there was an opinion that, there's still 4 lakh crores sort of NPAs waiting to come into the, waiting to be recognized, so to speak. So, corporate banks like Axis, ICICI, of course, is the forefront of lending, and if there is going to be further pressure on NPAs, I'm not so sure. The pace of NPA addition will maybe go down. They have an NPL of something, slippages of closer to 26,000 crores. This year, maybe it is going to be somewhat much lesser than this, but does it warrant that the NPA cycle has actually played? I mean, you got to be a brave heart to look into names like Axis Bank and ICICI Bank. I believe that if the numbers were to come through what has been opined, then obviously there's value on the table, but the whole point is who knows as to what the NPAs are going to be. We just keep on hoping that the NPA cycle has actually fully played out, but every quarter there are negative surprises, and given the number of cases in the NCLT, I mean, I'm not so sure whether the entire thing has actually played out. I think 2019 will be a year of transition, and 2020 onwards maybe you'll see the full NPA cycle actually having played out and growth thereafter. So I wouldn't be taking a call on these corporate lenders, even in the private sector space, leave aside the public sector banks.
Okay, Manish, I'll talk about a sector which currently is exhibiting signs of outperformance, and that is IT. Now, news is good for IT, but that's not across the board. TCS, good numbers. Infosys, positive and a constructive commentary, but that was not the case with an HCL Tech. That was not the case with a Wipro. So why the entire sector is getting re-rated when the performance and the management commentary also has been selective?
No, so it should be very selective. Of course, the big tailwind coming from digital orders out of the US is a silver lining as far as the growth numbers are concerned, and now there are stocks like TCS, etc., which has got re-rated to something like 26, 27 times earnings, and at the same time Infosys with, let's say, even to 6 to 8% sort of a dollar revenue growth has come down to maybe 15, 16 PE. So, at one point in time Infosys was actually trading at a premium valuations to TCS, and today it's just the other way around. So it all depends on, the re-rating or de-rating all depends on what sort of defense do you have against your margin numbers, because growth is going to be across the board. It depends on the deal wins and the margins. If deal wins and margins do show some resilience and leave aside expansion, then and I'm talking constant currency, not that the tailwind on let's say the rupee depreciating is obviously beneficial for IT and pharma names. There's going to be pick and choose. I don't think it's across the board re-rating that is warranted in the sector, and that is true even for the pharmaceutical names, because they also would be beneficiaries of a depreciating rupee. HCL Tech is more of IMS. Wipro has client-specific issues. So, given this, I think within the large cap, my preference would be Infi and then TCS. And the other two definitely I'd not be looking at.
Okay, Manish, great speaking with you. Thank you so much for taking the time out and telling us all about what the portfolio changes have been like and where is it that you're finding value in this current market.
Thank you.
So what is the market?